The average pension pot in the UK for those aged 55 to 64 is around £107,000 according to the Office for National Statistics. With that number in mind, this video is going to try and help answer how much income you might be able to take from a £100,000 pension from both Flexi Access Drawdown and also an annuity. Stick around to the end as I'm going to cover several retirement ages for those of you who may be thinking of wanting to retire early, or those who are happy or will have to wait until close to their state pension age. Let's start with drawdown and see what income you might be able to generate taking a flexible income. You can take as much or as little income as you like, and the flexibility can allow you to take more income during the active years of your retirement or before your state pension kicks in, and then maybe reducing it in later years or when your other retirement kicks in. With drawdown, you can take as much income as you like, so it's hard to say exactly how much income you might be able to take sustainably. But before you switch off, and I've mentioned this in other videos, the best way to accommodate this, I think at least, is to try and calculate what income you could take each year, really, to try and extinguish the drawdown pot at a certain age, which in other words will be based on life expectancy. Let's see an example then with Teresa. Teresa's life expectancy is age 90, and we'll set it so the drawdown fund pays out the same amount each year so that the pot is extinguished at age 90 for Teresa. I know, the whole point of drawdown is the flexibility and the ability to change your income, but I think for the purposes of looking at the sustainability of the income, this is one of the best methods and tools in your armoury. The income that is taken from the outset increases by inflation so that it maintains its purchasing power. For inflation, we'll assume 3% a year. For the drawdown pension that is not taken as income, we're going to assume that investment returns are 4%, and that's net of all fees. We'll base it on someone who retires at age 55, 60, and finally 65 to cover all bases. We'll start with someone who's age 65 and work our way backwards. For someone looking to retire at 65, this is a potential retirement term of 25 years. As this is the shortest time in retirement of the examples, this means you can take the most amount of income. Let's get into the numbers then. You could potentially take a starting income of £4,539, and this increases with inflation. And if you remember, for the pot to be completely extinguished at age 90. By age 74, the pension would still be worth over £84,000 that your beneficiaries or loved ones could potentially inherit if you croaked it tax-free. If we assume Teresa was entitled to the full state pension of £10,600 a year later at age 66, this is a retirement income of more than £15,000 without even accounting for a spouse or partner's retirement income. Looking at the Retirement Living Standards Survey, which I've harped on about before in other videos, this is £12,800 for a minimum standard of living in retirement for someone single, and £20,300 for a moderate style of retirement. If you're able to scrimp and save £100,000 in your pension, then you could argue a half-decent retirement is possible and is not just a pipe dream, particularly when you consider the average pension pot is already over 100k for those aged 55 to 64, according again to the Office for National Statistics. Anecdotally, that's a tough word for me to say, for the younger audience, auto-enrolment should certainly help things as well, assuming the state pension remains the same, which I know is a big assumption. If we assume somebody is age 30 and had no pension savings at this point, if they were employed on a salary of £30,000, the minimum auto-enrolment pension contribution from auto-enrolment would be £158 per month. That's 5% coming from you and 3% coming from your employer. If we then assume these contributions increase by inflation, and this person contributed this amount for 35 years, which would take them up to age 65, and the underlying pension grew by 4% a year, the pension could be worth over £222,000. You may be thinking, hang on, Alex, you haven't taken inflation into account. 100k in 35 years' time will be worth a lot less. However, with the growth rate, I've assumed that the portfolio grows at a reasonable forecast of 7% a year over this time. We'll knock off 3% for inflation and deduct 1% for fees, leaving us with that net return of 4%, which should mean the numbers quoted earlier are actually in today's money. Even if you felt 7% gross return was too high, if we used a more conservative gross growth rate of 6% or 3% net, the final pension value would still be worth over 185k. And that's in today's money. Age 60, that's more like it, you could say. More time on the golf course and less time in appraisals and one-to-ones, as the retirement term will be slightly longer by 5 years. There's more of a strain on the pension, so the retirement income would be less. This could provide a starting income of £3,822 per year. By age 74, pension would still be worth over £82,000. Along with the full state pension, this could potentially be a combined income of £14,422 in today's money. This would still be above what the retirement living standard suggests is needed for a minimum standard of living in the UK for a single person. If you retire at age 55, and if we assume a life expectancy of age 90 and the pension pot runs out at this age, this is a retirement term of 35 years in which the pension fund has to support you. As this places more strain on the pension fund, quite naturally, this may mean you'll have to potentially take less income compared to the previous examples unless you wanted to rely on investment returns being as strong as they've been in the past 10 to 20 years. A £100,000 pension at age 55 could generate a starting income of £3,340 per year that increases with inflation. To qualify for the full state pension, you'd need 35 qualifying years of paying the necessary national insurance contributions. If you started work at 21, this would give you 34 years. So something to be aware of if you are thinking of retiring earlier. For the purposes of this example, if we just assume the full state pension to make things easy, this would be a combined income of just under £14,000. So that's a lot of numbers. Let's see a summary of what the potential income a £100,000 pension could generate. Although you can't rely on these numbers absolutely, it does show you how the longer your retirement, and this could be either retiring early or the more unknown and morbid opposite end of the spectrum, living longer, it may mean you have to spend less. Let's see an example of how drawdown can go wrong. In this example, we're going to tweak the assumptions from earlier. For someone who retires at age 60, we'll assume net investment returns are much worse than expected at 2% a year, which is below inflation. And 7% of the pension, or £7,000, is withdrawn from the pension each year as a starting withdrawal, and we're going to increase that by inflation as well. In this scenario, pension would run out at age 74. This could potentially leave you with an uncertain future for your remaining years, particularly if you've been accustomed to the good life. For annuities, we're going to focus on lifetime annuities. With an annuity, you essentially swap your pension fund in return for a guaranteed income that is paid for life. Once you die, that's it. The annuity usually dies with you. It is possible to add inflation protection and also a survivor's pension so that the income maintains its purchasing power and can also provide a pension for your loved ones if you do die prematurely. But this will usually reduce the starting income. As the income is guaranteed, there's no risk of the pot running out, as the annuity, as I say, is usually paid for life. Annuities fell out of favour after the pension freedoms were introduced in 2015 and because of the ultra-low interest environment that existed right up until 2021. You can see how the potential income from annuities has increased dramatically as interest rates have risen in recent years to combat inflation. The amount of annuity you can get will depend on many factors such as how old you are. Usually the older you are, the better the rate tends to be, as the insurance company rather morbidly will statistically work out you've got less to pay. They'll pay less due to a shorter period of time. Your health is another factor. If you have any health conditions, you may be entitled to something called an impaired annuity, which can basically mean you get a higher annuity rate and more income. If you add any inflation protection or survivor's pension, this is again going to reduce the starting income. The annuity rate will be different as well from insurance company to insurance company as they compete for your business. As with the drawdown example, we'll give examples of an annuity purchased at age 55, 60 and 65 to show you how the age at which you retire can affect your starting income. Both are going to assume this is for someone in good health. It's worth mentioning that annuity rates change all the time, as we could see in the graph earlier. As you can see, the age at which you retire really does affect the level of annuity income that you may be able to get with your pension. If you retire at 55 compared to someone at age 65, your annuity income could be as much as 40% lower. Knowing how much income you can take from your pension is really important, but if you want to try and minimize your risk of running out of money in retirement, then watch this video, which looks at some of the most common mistakes that I've seen when it comes to drawdown and how you can try and avoid these.